Hello everyone and welcome to this edition of our Quarterly Insight webinar series, this one titled Credit Where Credit's Due. Thanks for joining us. Before we get into the content of the webinar, just wanted to go over a few housekeeping points so you know how to participate. Firstly, you're using your computer audio to listen to the webinar and you're also in listen-only mode. Whilst that means you can't submit questions by talking, we would really encourage you to submit questions for our speakers by the questions pane of your control panel. We're going to hold a certain amount of time at the end of the session for those questions. The topics are quite engaging and the speakers are obviously experts, so we'd really encourage you to submit those and get involved in the conversation. Finally, the webinar is being recorded, so whether you want to re-listen or you have colleagues who haven't been able to join live, we'd really encourage you to take advantage of that recording. That'll be submitted 24 to 48 hours after the session. Before I hand over to Maurice, there's a last word from me. Today, Demica released our trade receivable securitization playbook. That's a collaboration with TMF Group, and it's really designed to give some expert insights into trade receivable securitization as a product. Particularly given the caliber of the people joining on the call today, we think it's a really relevant topic for this group. It's really designed for sophisticated market participants who already have some understanding of the product, possibly utilize it or possibly serve it up in some way, but want to deepen their understanding and expertise. There's a few of the topics covered on the screen there, but other than that, I'd really encourage people to visit the link, which I'll shortly be popping in the chat, to download it for themselves and take a look. Thanks very much for giving me a few minutes at the start. With that, I'm really happy to hand over to Demica's Chief Commercial Officer to begin the webinar proper, Maurice Benisti.
Thanks, Dan. Sorry for the late start. We had some technical issues, but we've resolved them now. And I have Xavier with me, who's with us by audio, but not by video. So back to the old days of conference calls, if you remember that well, Xavier.
I do. I mean, we've learned to work differently. It'll test our flexibility.
Exactly. Well, look, just to, if you can move to the next page, Dan, just to cover off the introduction. So I've known Xavier for many years. I worked for Xavier in GE Capital before I joined Demica. Xavier has an incredible range of experience, both with reference to different financial products across consumer and commercial finance, obviously now through insurance and a real global experience set, having worked and run businesses across the world. And after 15 years at GE Capital, took up the position of CEO of Coface, where he has had been looking, Xavier, at some of the transformation metrics, if they can be described as such. I was looking at the size of the business when you took it over and where it is now. And so I guess what would be really helpful to kick things off is just to get a sense of your journey through, through GE and into Coface, and how you've transformed Coface in many ways. What was top of mind when you started, and what kept you going through it?
Yeah, as you noted, Maurice, I've pretty much got 35 years of financial services industry behind me, and I like to summarize it in a simple way, which is 30 years in 30 countries. I've had a career that spans, as you said, about everything that happens in banking, except I would say trading. So I've never been a trader. But everything else, from commercial banking to structured finance to consumer credit cards, loans, and retail banking, I've pretty much been involved with. I actually started my career in insurance, both in P&C and in life insurance, and then moved on to banking, and spent 21 years in GE. Fantastic journey. As many of you probably know, the GE Capital story of incredible years of expansion, followed by, I would say, the GFC and then the reduction to its core, which is financing the GE sales. I left GE in 2014 and was appointed as the global CEO of Coface in 2016. And it's been a transformation. This is This is a company that has been in existence for 100 years in Germany, 75 years in France, is a true global player in the financial services space. We have clients in 100 countries, and we take risks in 200 countries. We've survived all the crises that have, as you know, marked this last century. And we've developed a quite unique, I think, infrastructure to monitor and manage what is now 700 billion of credit risk across 2.5 million companies in 200 different markets. So the journey we set out on in the beginning of 2016 was one of changing the culture of the company. It has a deep and rich heritage coming from the years that it spent being the armed instrument of actually France to finance export. It was clearly the leader in the market of export finance, and then expanded into domestic operations and expanded throughout the world through acquisitions. And we centered that culture around four things. One is becoming very client-centric. We have 50,000 corporate clients. We have a retention rate, an annual retention rate of something like 95% of those clients, which means that we have client relationships that will span decades. And our job is to help those clients trade safely. You probably know that about a quarter of all failures are due to somebody not getting paid. And so managing your exposure to risk of payments is something very important for companies. And Coface has developed over the years an incredible infrastructure to help companies do that, whether it is an information database, systems, people, experts, knowledge, sectors, economic research. And we put all of that to work. We have about 5,000 employees around the world. We put that to work on behalf of those clients, trying to help them steer their business safely through what is a more and more volatile and unpredictable world. So clients, number one, expertise, as you probably already guessed, is number two, because in order to do this well, you need a unique set of know-hows. Of course, you need data. Of course, you need technology, but you also need people. You also need language and legal and the controls and all sorts of things that are absolutely critical. So this is a company of experts that put their know-how collectively to work for clients. That's why our third value is collaboration. You can imagine that when you work for a corporation that spans several continents, we have to have people in all four corners of the world work together effectively in a fast and efficient way to take care of this client's business. And I'll just give you a couple numbers. We make about 10,000 credit decisions every day. Our turnaround time when somebody asks us for a credit decision is less than a day. And just to illustrate the point, when I joined the company, it was about a week. So we went from taking a week on average to taking less than a day to make a decision.
And that's a big change. So what was behind that change? So unpack that a bit. In terms of what you had to do to get people behind that as being possible, and then the kind of how did it happen?
It's well, I mean, all of my experiences in financial services have been the quantum improvements in time metrics. I mean, it was true in GE, and I think it's true in Coface as well. You all know that the world is accelerated, and that's mainly due to technology, by the way. What took our grandfathers, months, we can now do in hours, and I think that trend is continuing. So behind this is technology. It means that a lot of the decisions we make are now made on the basis of available data, sometimes and a large number of times with computers. We have we have leaner processes, we have more connectivity with clients, and then it's the culture of the company. It's also the system of delegations, who makes the decisions, who produces what, when, where, and we've brought all the intelligence as close as possible to the clients, as localized as it can be, in order to be able to minimize the steps and the number of layers that things have to go through to be able to act.
And the size of your technology team, right? Because I guess you look at it on a long enough term basis, and Coface becomes a technology. I think many businesses become technology businesses. But how has the size and weight of the technology function changed within Coface since you started your journey?
Well, we started the journey actually with a technology investment plan. So we committed, I think at the time, something like 70 million into technology, but the number has been, I would say, multiplied since then. So technology is in the core, because you do not get anything done in this world if you do not have good, reliable, fast systems. They are expensive, but also they are the best way I know to reduce errors, to increase speed, and to foolproof processes. So get rid of as many human errors as you can, and to lower the cost. So I think technology becomes, in financial services in general, and it's true for us as well, more and more important every day, and a larger and larger share of both management's attention, and I would say the overall investments that we make in the company.
Yeah, and we see this with our bank clients. So we're involved in a number of trade transformation projects within the trade, open account, trade finance at our banks. And I think some of the challenges that the banks have is there are so many different calls for investment across their product suite. So it becomes, it opens up opportunities for companies like Demica, because there's more of a tendency to buy versus build. But you've got a lot of very different financial products calling on that spend and prioritization. So I think it's, what we've witnessed is making the choices as to where to invest and how to invest from our banks. And then to your point on the culture, right? How do you drive a mindset of transformation in institutions that have been doing things the way they've done them for a very long time? And I guess that must have been that must have featured in your journey from a cultural perspective.
No, absolutely. So there's really two topics. One is I think you're right to point out that there's an infinite thirst for money on the banking side, or on the financial services side, for investment, for technology investment. I think you could spend an infinite amount of money, and everybody knows the resources are scarce and constrained. And it's not just the money, actually, it's the expertise and the time of the people who are going to be making the changes. So you have to pick carefully what you're going to invest in, under which sequence, and how much you're going to try to do at once, because sometimes trying to do more is actually counterproductive. So I would say this whole process of selecting investments and making sure you deliver effectively on the goals that you set for yourself, that you prioritize them, that you do them in the right order, and you get things done and finished, and you clean up after you've done something. I think these are absolutely critical factors in being successful in financial services in general. It's true for us, and I think it's true for all the banks. In terms of the people culture, I think people are both fearful of change and in a large desire to change. I mean, it's an ambiguous relationship we have with change, because we know change is good, but change is painful. It sets you it requires for you to learn new things, to do things differently. It requires the last value, which I didn't have time to mention, which is courage and accountability. A lot of people complain that they don't have enough power, that they don't have enough delegation, that there's too much bureaucracy. True. But then the question is, when you actually give them this power, will they exercise it? So you have to create a culture where people are able to get responsibility, but they're also required to take responsibility. And you have to have a system where when they do take responsibility and they make mistakes, which is part of responsibility is making mistakes. One, those mistakes don't kill the whole company, and second, they learn from there, and they are not punished for making a mistake once. If you keep repeating the same mistake over and over again, then obviously that's a different.
Yeah, you want to make different mistakes. That's one of my mottos, right? You won't punish someone for making.
Yeah,
mistakes.
I mean,
don't do the same one.
Absolutely.
And I think just to round off that topic, one of the other things I've noticed through different transformation processes, and also in the growth of our business, we've been growing our revenues at a compound annual growth rate of around 35% since I joined the company. And so that level of growth from a very early stage venture, which was Demica when I joined it, you do see a real change in the way people, you have to challenge yourself on making sure that you don't reinvent the same processes as you transform, right? So either because you're growing and you've used certain processes to grow, especially as an early stage business, you have to change them as you go along. But from the banks, as they run through these big projects, that they don't re-architect what they already have. And that's tricky because people I agree with you, people do want to change, but at the same time, people are always have the temptation to reinvent what they already know.
Well, that's true. That's very expensive, but I think, like anything in change, you've got to have change agents, leaders, people who will take the risk, who will show the way. There will be resistors, and you have to find a way to neutralize them. And then there's the bulk of the people will follow the lead. And you have to show that you can win. You have to show success. You have to have examples. So I think any change program goes through this. Same for us. We've led. I think that the benefit for me of having spent decades in this industry, turning around businesses, facing, quite frankly, all of the major crises that most of you know about, from the 90s into today, we have had our share of situations. All of this gives you the confidence to take steps pretty quickly, act on it, and be a little bit bolder. And I think that's paid off for us.
Yeah, that's great. Dan, why don't we go onto the data side and we can talk a little bit about what we're seeing. So, as I think many of the folk who attend our webinar know, that we take receivables data, sales data that's running through the network, around $100 billion of sales across a number of different industries, and we look at the trends. We started this during the pandemic, and we've continued. So we go to the next page, Dan. What we've done here is we've just we've pulled up the Coface risk metrics or logos on the left out of their quarterly barometer, and then we've put in some of the data updated for Q3. And without going through every single chart, I think what we're seeing come through, and be interested in your perspective, Xavier, because obviously you have access to a much bigger data set, and a truly global data set. But we are starting to see, if we look at ICT, we're starting to see that sector level out as it recovers from or as it comes through the kind of pandemic boom that it had. And we've got a number of customers that are in this category, whether it was e-bikes, or whether it was ICT, or whether it was outdoor garden equipment, companies that had huge booms in activity that came off and are now starting to stabilize. We've seen that, and then I guess the other factor, the other trend that we're seeing quite clearly, and you see this on kind of paper packaging and transportation, which are the two charts on the right. And just to remind our listeners that the index is indexed to Jan 2000 when we started to do this. But you are starting to see a softening in 2023, which does feel like it's tied to what's going on in the economy and consumer confidence. And obviously, this doesn't reflect any of the events of the past, the past month, as geopolitical risk has taken a sharp turn upwards. But those are some of the things that we've seen. Does that resonate with you? Do you see similar, or what would you draw to?
Well, I mean, it's clear that we've had a series of shocks in the last few years that have been completely exceptional. And by the way, we're completely incapable of predicting those shocks. So we had the COVID pandemic, and we had a boom in ICT because everybody started working from home and trying to equip themselves with computers. So I think that was actually a very good period for people who have computers could find them. And obviously, like any boom, then you've got a slowdown that follows. And I think what you're describing, is consistent with the trends that we've seen in the market. You also are aware that during that COVID period, government spent an incredible amount of money supporting the economies to try to keep things running and avoid companies failing. I don't think we've seen anything like this in our history before. We're talking trillions. And as you all know, this triggered the resurgence of inflation. Everybody was asking before the crisis, where is inflation? They had so many articles being written saying inflation should come back, but it's gone forever. And finally, inflation came back, and it came back raging, actually, which caused the central banks to tighten their credit conditions and raise interest rates. And I would say that's almost like the topic of the day, right? I mean, who's going to do what? But it takes time for the rate policies and monetary policy to percolate down to the economy. It takes time all the more since we started from a situation where everybody is lavish in cash and the treasuries and the margins are very good. So it takes time, and I think we're starting to see that effect take hold. And you've seen the latest numbers on inflation; they're actually lower. So we are seeing an impact, and of course the future is to be written in terms of where this is all going. But the first to be impacted are those that have the least cash, whether it be consumers or businesses. And it's typically those that are in high needs of borrowing. And so, you're all aware of the slowdown in I would say the mortgages around the world have been hit, and construction is slowing. And so you see some of those trends, I think, in the numbers that you are describing, Morris. I'm on the phone, so I don't have access to the chart that you're showing, but I kind of remember what it says.
Yeah, no, it's just showing a kind of softer performance relative to last year in those sectors that are more tied to the consumer economy. There's another chart that looks at auto, because we have quite a large number of auto parts manufacturers in our base, and that actually has seen some respite this year after 2-3 very difficult years. So it's a little bit of a mixed picture. You've got, as I say, things leveling out after the pandemic, and as you say, the huge interventions that came with it. Some softness as a result of inflation and interest rates going up, and then you've got industries going through massive transformation, electrification, and so on. So I don't know about you, but it does feel that life becomes less and less predictable, both with respect to the geopolitical and the shocks that get inflicted from a world that is in many ways less united than it was, with less of a consistent direction of travel, and then you've got industries being transformed. And I suppose, being in the risk business, that must make things kind of interesting for you.
Well, I mean, I've actually written a book during COVID called The Values of Risk, which you guys will find on Amazon or wherever, which actually talks about this, because as we went into COVID, a few things crossed my mind. I have gone in my career through many crises. This was one more, and I thought, okay, when companies go through a crisis like this, some do very well, some do not as well, and why is that? And if you think of COVID, I think some had predicted that the next pandemic would come from somewhere in Southeast Asia and would be tied to animals, right? And but they didn't say when, which virus, and how to fight it, and what the consequences would be. So we're quite incapable of predicting those things. It's true for health issues. It's true as well for the geopolitical risk. I don't think anybody saw the war in Ukraine coming, or nobody thought actually until the very last days that it would actually happen. And I would say pretty much your ability to plan, if you're running a company today, your ability to plan and forecast has been diminished. Geopolitical risk, we thought, was gone pretty much because the world was converging nicely to a peaceful world of open trade, and everybody thought the democratic model was kind of the trend that everybody was aspiring to. We've seen that this is not true anymore. Trade has become actually more difficult. We are seeing pandemics come back, or it feels in a way that these things, which were the main concerns of people in the Middle Ages, are back, right? And so we're not in the Middle Age. We're in an age where things happen a lot faster and a lot more interconnected. And so your ability to plan is less. So what matters more is your ability to react and to manage. And I like to say, I'd rather be broadly right than precisely wrong. I think one of the things companies have tried to do to limit risk is to control things in a very precise manner. And when you do this, you're focused on one scenario. You forget that things could be very different than your central case. And when that happens, what do you do? And I think your ability to maneuver, to improvise, to react, to have thought beforehand as to what would happen if inflation doubles and what happens if inflation disappears. How do you manage? What do you do? These kind of what if scenario planning is more and more important, or more important than ever.
And when you look at when you, because you've got a truly global business, looking at the difference in terms of risk outlook for Western Europe and North America, you see North America holding up a lot better than Europe, as an example. How much does that affect the way in which Coface thinks about kind of risk taking and risk management as you look at different regions?
Well, I mean, going back to the conversation we were just having, I think every year we've tried to plan what is likely to happen next year, and pretty much the last 3-4 years, those plans have turned out differently. If you read the literature on what's going to happen in 2023 that was published at the end of 2022, I think the kind of consensus was Europe's going to be okay, the US is going to slow down because the Fed is very aggressive in its hiking, and Asia is going to benefit from a massive rebound of the Chinese economy.
Yeah.
And so that I think that was kind of the consensus a year ago. And you're aware now of what's happened. China has not rebounded, and or at least not the way people were hoping. The US is actually doing very well, and Europe is on the brink of no growth or plus epsilon or minus epsilon. So things have turned out differently. And again, we try to forecast, but we can't bet on one scenario. So what we do as a company is we help our clients make the best possible decision based on the freshest, most up-to-date, most accurate information possible. And we don't look at, I would say, an economy or a country as one monolith. We look at the individual companies, the individual counterparties that every one of our clients is dealing with, and we make a one-by-one decision. That's what we do, depending on where you are in the value chain, what kind of clients you have, what kind of product you produce, of course, what country you're in, but that's, all of these factors play into how well you're going to do, regardless of what the scenario out there is going to be. It could be favorable to you, could be unfavorable to you, could be favorable to you, unfavorable to your neighbor. I think the devil's in the details, quite frankly, Maurice, here.
Yeah. Yeah, no, that certainly resonates. I guess the final thing we were going to talk about was, Coface has a significant factoring business, and a lot of our listeners are in the kind of trade space, receivables discounting arena in different shapes and forms. And we've been able to collaborate with your factoring business to do some things together, which has been great. Feels to me like with higher interest rates and inflation, trade finance is often, or at least working capital finance, is often a little bit counter-cyclical. Cash flow lending, easier credit becomes more scarce, and then there's a reversion to asset-based lending of different forms. Is just interested in your perspective. Is that what you're seeing? How do you think about that?
I think the factoring activity is actually very similar to what we do. Excuse me. To what we do in trade credit insurance. One is the other without the liquidity, right?
Yeah.
The ultimate risk is the same. It's just whether you provide the liquidity on top or not, right? So it kind of basically it relies on the same infrastructure for us in terms of risk management analysis, and it also evolves in similar ways in terms of the need that the clients might have for one or the other. So the volume of receivables that are being financed or insured, it starts from the same place, right? Clearly, when credit conditions are tighter, people look for ways to monetize, their assets or create liquidity buffers, and so as they also look for ways to protect their receivables and trade safely. So I think on one hand, when the world gets more complicated, it makes it more risky, but on the other hand, it increases demand. And I think whether it's factoring or trade credit insurance, we see the same trends.
Yeah, we're seeing we're certainly seeing an increase in demand from corporates, as I said, because kind of interest rates have gone up, and particularly in the leveraged space, liquidity has become more highly valued, and therefore alternative sources of liquidity have become highly valued. And in fact, we're starting to see private credit expand into the working capital finance space in a meaningful way. So asset-backed lending had been, has been a growth area for private credit for quite some time, but kind of your receivables discounting, factoring, that is really stepping up pace, and particularly in the US. So an interesting one, and we'll see how long this cycle, how long it takes for interest rates to, whether they stay where they are or whether they revert to somewhat more normal levels, whatever normal looks like.
Mm-hmm. Yeah, I mean, it's anybody's guess. If anybody knows, they would be rich, right?
Yeah, absolutely. Well, look, really appreciate your time, Xavier. It's been great to catch up and talk to you and hear your perspectives. We, as I say, we certainly have a great partnership with Coface on many levels, and it's been great to see what you've achieved over your tenure, and I'm sure you've just started. So great to talk to you, and thanks very much for supporting our Insight series.
Thank you very much for having me.
All right. Thanks a lot, Xavier.